Good morning. We will pay attention to the effect of debtors' allowances on sales when goods are returned to the business. Every time when an allowance is given to a debtor, you must determine if it will have an effect on the cost price or not. Any deduction on the account of a debtor is always recorded in the Debtors Allowances journal. When the accounts of debtors are reduced, you must determine if it will affect the cost price. The only exception is that you will record the payment and discount in the cash receipts journal. Any other times that you reduce the account of a debtor, it will be recorded in the Debtors Allowances journal. Goods returned. When debtors return goods, it will have an effect on cost of sales. Because the goods are returned, it will increase inventory. The expense for cost of sales will reduce because the goods are not sold and are not allowed to form part of the expense. You have to complete two double entries. Reduce the account of the debtors control on the credit side and debit the debtors allowances account to decrease the income with the sales price. Increase the inventory account because the inventory was received back in the business, and reduce cost of sales with the cost price on the credit side. When damaged goods are returned, it will have an effect on cost price because the goods are returned and will increase the inventory. The expense of cost of sales will be reduced because you are not selling the goods and they don't form part of the expense. Even when damaged goods are returned, you still have to do the two double entries. B now return damaged goods with a sales price of 400 and they make a profit of 25% on sales price. So therefore sales price will be 100% and cost price will be 75%. You have to complete two double entries to reduce the debtors control on the credit side and debit the debtors allowances account to reduce the income with a sales price of 400. Increase the inventory account and reduce the cost of sales account with a cost price of 300. Because the profit is made on sales price will be 100%, profit 25, cost price 75. The sales price is given as 400, so 100% equals 400. If we want to calculate the cost price, 75 divided by the one that we know, 100 times 400. They returned the goods to the supplier. Then the inventory will be reduced and the debt of the creditors will decrease. So you first have to complete two double entries for the goods that was returned by the debtor, and if the business returns the goods to the creditor, an additional two entries will be recorded. When the debtors return the goods, you will decrease the asset on the credit side with 400 Rand and you will debit debtors allowances with 400 Rand. You will credit cost of sales with 300 Rand to reduce cost of sales, and you will increase the inventory with 300 Rand. When the goods are returned to the creditor that is a liability will decrease on the debit side with 300, and you will credit your inventory asset on the credit side with 300. Debtors allowances is debited to decrease the profits. Debtors control is credited to reduce assets. Inventory is debited to increase assets with a cost price. Cost of sales is credited to reduce the expense, and if expenses reduce, profits increase. Creditors control is debited to decrease the liability, and inventory is credited to reduce the asset. When we return goods to a credit note will be received. When a debtor returns goods, a credit note is issued to the debtor. When the account of a debtor must be reduced, the debtors' allowances will be debited and debtors' control will be credited. You have to determine whether the debtors' allowances will have an effect on cost of sales. If it will reduce cost of sales, inventory is debited and cost of sales is credited. When damaged goods are returned to the creditor, the entry will be completed to reduce the inventory and to reduce the amount that's returned to the creditor.